A hotel project rarely fails on opening day. It fails much earlier, at the feasibility stage. This is one of the most critical yet underestimated truths in hospitality development. While investors often focus on land, design, or brand tie-ups, the feasibility study is what defines the project's direction and long-term viability. A weak feasibility study doesn't create small gaps, it embeds structural flaws into the project. It leads to decisions that appear viable on paper but fail under real market conditions when capital is already committed and flexibility is limited. One of the most common issues is overestimating demand. Many studies rely on generic or outdated data, projecting strong occupancy without accounting for seasonality or market saturation. The result is underperformance from day one: empty rooms, aggressive discounting, and strained cash flows. ADR projections are another frequent risk. When room rates are set without deep competitive benchmarking, the hotel enters the market overpriced. This forces price corrections, impacting revenue and weakening brand positioning. Once a hotel begins heavy discounting, it is difficult to reposition it at the intended rate. Location analysis is often oversimplified. A strong feasibility study evaluates micro-market dynamics: who is traveling to the area, why they travel, their stay patterns, and price sensitivity. Without this clarity, there is a disconnect between the product developed and the actual target market. Cost estimation is equally critical. Underestimating development costs, whether construction, MEP systems, pre-opening, or working capital, creates budget overruns and funding gaps. When combined with inflated revenue projections, this results in unrealistic ROI expectations that cannot be achieved in real operations. A robust feasibility study goes beyond identifying risks. It defines the right strategy. It answers key questions: what to build at what scale, for which market segment, and with what facilities. It ensures that the product is aligned with demand and that every investment contributes to revenue and operational efficiency. It also directly impacts design and planning. Without feasibility-backed clarity, projects are often over-designed, inflating costs, or under-designed, failing to meet guest expectations. Both scenarios reduce financial performance. Brand selection is another critical outcome. Whether independent or operator-led, the decision must be aligned with market demand and financial projections. A mismatch here can limit the hotel's ability to compete effectively, regardless of brand strength. Operational planning also depends on feasibility inputs. Staffing structure, service levels, pricing strategy, and distribution channels are all derived from initial assumptions. If those assumptions are flawed, operations begin with inherent disadvantages. In essence, a feasibility study is not a formality, it is the strategic foundation of the project. It must include detailed market analysis, realistic financial modeling, competitive benchmarking, and scenario testing. It should challenge assumptions, not validate them. Successful hotel projects are not defined by scale or aesthetics, but by the strength of their fundamentals, established at the feasibility stage. If the numbers don't work on paper, they won't work in reality. And if the strategy is flawed at the start, no level of execution can fully correct it. Before committing capital to development, invest in getting the feasibility right. Because in hospitality, a poor feasibility study doesn't delay failure, it builds it into the project from the beginning.